Hello, it's Craig Tapping from Mastering the Markets. I'll take you through a little bit about what I'm seeing in the markets right now because the markets have changed significantly over the last week or so. And that's been driven by the geopolitical escalation in the Middle East, the reclosure of the Strait of Hormuz, and the impact that that's having on the oil price and the flow on impacts that that's having across global economies and about to hit global markets pretty hard. So what I have in front of me here up in the chart is the US oil price, WTI crude oil. And what you can see is in the last couple of weeks, we've seen the price of oil re-escalate and go back to where it was pretty much seven or 8 weeks ago. So throughout the whole of June, we had a really nice move down from the 90s down to 67. And in over the last few weeks, we've gone back up into the $90 range. And in fact, Brent crude oil has actually hit $101 over the past day. So what we've seen is pretty much a 40% increase in oil price, and that is impacting the markets quite significantly. So if you look at the biggest impact that this does, is this has increased a huge probability of inflationary pressure. When the price of oil goes up, the price of petrol goes up, the price of diesel goes up, the price of all energy goes up, it feeds into everything that we buy. And what we can see in the markets is we can see that the markets are starting to show a little bit of fragility at the moment. And we're sitting in a situation, and I've often said on these videos that the markets don't top unless one of two things happen. The first thing is the market doesn't top until earnings top. And we are in peak earnings season right now. And the second thing is the market doesn't top until the Fed and other large central banks tighten monetary policy. And what I mean by tightening monetary policy is putting up interest rates. And what we are seeing now is we're seeing the real reality that interest rates are potentially going to go up across the world. And when we look at how the markets factor in the likelihood of interest rate hikes, we look to the bonds markets. And when the bonds sell off, the rates, the yields of those bond markets are inversely correlated. So the more people sell off on bonds, the higher the yields go. And it's the market telling you that they don't believe that 4% or 5% is enough payment to be investing my money in government debt. What we feel is we should be returned more. So they feel it's not a good deal. They sell off their bonds, the yields go higher. So when we look at the US yields, and I've got three sort of timelines on here, the 2-year yield, the 10-year yield, and the 30-year yield, you can see that since the war started at the end of February, yields have gone up a huge amount. Now, what we started to see is we started to see the 10-year and the 30-year come back when we started to get ceasefire agreements. We started to get a memorandum of understanding. We started to get slightly cooler CPI figures. But the 2-year yield has been relentless. This has not come back. And the 2-year yield is the market's anticipation of what the Fed is going to move the Fed funds rate to. Now, when we start to look at where the Fed funds rate was, and the Fed funds are sitting at 3.5 to 3.75, so averaging 3.63, what we saw with the 2-year is the 2-year was below the Fed funds rate. And what that means is there's a high likelihood that the Fed is going to cut rates. And the Fed did start cutting rates in 2025, and we had a couple of Fed rates, and we entered 2026 with the expectation that there would be more rates, and then rate cuts, and then the war started. And since the war started, what we're seeing is the expectation of rate cuts has completely disappeared. And now we're not only factoring in no rate cuts, we're actually factoring in significant upside in terms of potential rate hikes. And when we look at the Fed funds rate now compared to where the expectation of the market is, it's going up 0.73%. So that is potentially three rate hikes on the horizon over the next potentially 3, 6, 9 months that the Fed could be looking at. So if oil keeps trading at $100 a barrel or north of $100 a barrel, what we're going to have is we're going to have this rising inflation. And that is the likelihood that the Feds are going to have to hike rates quite significantly. Now, when we look closer to home and we look at the Australian rates, we can see that we had a problem of Australian rates all the way back to November. Before the war started, Australia never got on top of their inflation. They didn't go high enough initially, like a lot of other places across the world did, and what we never managed to stamp out inflation. So back in October, we were already talking about hikes, and in the beginning of this year, we already had 3 hikes. But what we were starting to see in April is we were starting to see the yields come down, and the yields coming down said to us that the rate hiking was over. And what we could do is we could hopefully see inflation cool over the next 6 months, and maybe in Q2 next year or potentially Q3 next year, we would be then looking at a rate cutting cycle and getting back to lower rates. But since the war has escalated over the last 3 weeks, look at what's happened to rates again. They've just gone absolutely crazy. So the 30-year yield sitting at 5.5%, the 10 years over 5%, and the 2 years sitting at 4.7%. Now, the RBA cash rate's at 4.35. This is already telling us that there's at least one hike back on the table for Australia. So no longer can we feel secure that there's no more hikes. We genuinely are back in terms of talking about rate hikes being on the table. And if this continues to go up, there might be 1 or 2 rate hikes before the end of the year. The other country that we need to pay a lot of attention to is Japan. And Japan has often been known as the cheapest money globally. And Japan has historically had incredibly low rates. You know, they've been at negative cash rate, negative 0.1%. And over this period of time, back in 2024, August 2024, we actually had a very severe short-term crash in the market, which was known as the Japanese yen carry trade unwind. And that was back when the Bank of Japan moved their rates from negative 0.1 to a positive 0.25. And that created a massive unwind in the market because people were arbitraging, getting cheap money from Japan and investing it in Europe and investing it in American markets. And this was a cheap way to finance investments across the globe. And as the Bank of Japan have now put up rates and they've gone from 0.25, 2.5, 2.75, and recently to 1%, this is causing a major problem because it's causing a lot of people to unwind positions in the markets and take money back into Japan. Now, the scary thing is Japan's bond yields are not slowing down. So the 2-year is pointing to another 0.5% increase. That's another 2 increases by the Bank of Japan. And we know how volatile the markets can be when the Bank of Japan puts up the cost of money. So this is a major issue, and the 10-year yield and the 30-year yields are at levels that we have never seen in Japan. We historically have always had incredibly low yields and incredibly low interest rates in Japan, and for the first time, you know, we're having a generational change in terms of monetary policy outlooks for Japan, and that could have a significant repercussion on the markets as a lot of that funding in the markets unwinds. So moving on from yields, what are we seeing and how are these yields feeding into the markets? And if I pull up the S&P 500 and I start to look at what I'm seeing is we still got a bullish market structure. We've made a low, we've made a lower high, but then we haven't made another lower low. So we've protected that. But if we lose that, then we have a change of market structure, and that then confirms that we have a breakdown. So what we were looking at is with earnings coming right and with the war finished, would we have one more push to the upside? The likelihood of that happening now is looking less and less likely as the days progress and as the yields and the inflationary risk pushes up higher, and especially when we look at what the yields are saying we should expect from the central banks. And they're certainly saying that central banks will likely be raising rates over the coming months. Now, if we lose this, the sort of first level of support is a 9% drop from the highs. The next big level of support is right here down, a 20% drop in the market. So we don't know what we're going to get yet. There's the element of the earnings reports, and we're in full earnings seasons, as I mentioned, and we're also in the hands of the central bankers in terms of how aggressive are they going to be. So a mild pullback would be something that we just, is this an A wave? Is this a sort of B wave? And have we got a C wave down? We find support here. This becomes a great buy the dip opportunity, and we rally again. Or do we have something much bigger and much more sinister that takes us down, back to the 382 retracement level and previous support previous resistance that hopefully will step in as support, and we have a bigger correction. Looking at the NASDAQ, we can see similar things. Now the NASDAQ looks a lot more bearish, right, than the S&P. The S&P's been making higher lows, but what we've now made is we had a low here, we had a low here, and we've now made a lower low. And if we lose this level, then we have a complete confirmed change of market structure. We have a low, we have a lower high, and we've now taken out that previous low. That means that we are in a bearish market structure. Looking at key support levels for the NASDAQ, this could be a 15% pullback from the NASDAQ's recent highs, or as much as a 25% pullback if it doesn't find support here and goes down to the next level. Dow Jones was showing a huge amount of growth. And this was looking really, really strong. So last week when we looked at it, it was looking really strong. We weren't seeing any bearish divergence on the Dow Jones, and we were making higher highs with good momentum. Now, if I throw on a few moving averages here, what we can see is we've lost the 20-day moving average. We've now coming up to the 50-day moving average. Now, a good level that we sort of expect is the sort of moderate pullbacks come back potentially to the 200-day moving average, and deeper, really deeper pullbacks would likely come back to the 200-week moving average, which aligns with a key support level, a key resistance level, and that would probably give us around about a 15% pullback in the Dow Jones. Looking at the Russell is also starting to show a little bit. Now, we had bearish divergence, and we went through that last week. We were making new highs but with lowering momentum, so we already were seeing weakness. But now what we've done is we've lost the 20-day moving average, and we're just holding the 50-day moving average. And if we lose this together with this big support base, we then once again get that change of market structure. We've got a low, we get a high, we get another new low. That changes our market structure into a bearish market structure. First level of support, 11% drop. Next big level of support, 20% drop. 11% support will come in line with the 200-day moving average, and the 20% support will be more in line with the 200-week moving average. So those are the sort of key levels that I'd be watching for. And being a midterm election year, the seasonality is really, really clear that July, the first 3 weeks in July is bullish. The last week in July tends to turn bearish. August and September is incredibly bearish, and then we start to show recoveries in October. So it means that we could be in for an 8 to 10 week correction. And that's why these are the sort of key levels that I'm looking at. And as history doesn't repeat but often rhymes, and those seasonality calendars are incredibly helpful to understand, when are the most bearish months of the year. And the two most bearish months of the year in the US markets in a midterm election year is August and September, which we are about to enter. Looking at what does this mean for commodities? So when I look at commodities and I zoom out at commodities, and I've got a few different commodities on here. I've got oil, and you can obviously see how volatile oil has been since the war started. We had this massive what was that, an 80% move up on oil. We then came back down, a sort of 40-50% reduction in oil. And as I said, we up 40% in the last 2.5 weeks on oil since since the memorandum of understanding fell away. Now, what you can see is precious metals are still correcting. So they had a massive 2025. The second half of 2025 for precious metals was epic, right? There was a lot of leverage trades in that, and a lot of leverage had to unwind. And it's normal, considering that precious metals bull market started in September 2022 and ended at the beginning of this year. That's 3.5 years worth of gains. It's normal that a correction could take some time. So yes, rising yields is really bearish for metals and really bearish for growth. And at the same time, we're also in a correction cycle for precious metals. So precious metals have been hit pretty hard. And, just since the war started, you can see that, here we go. Gold is down 20% since the 28th of February when the war started. Platinum's down 30%. Palladium is down 30%, and silver is actually the hardest hit, down almost 34%. The interesting thing to note is how well industrial metals are holding up. So even though these are growth assets, and growth has been really challenged in terms of high inflation and higher yields, we can absolutely see the strength and the resilience of the industrial metals. And I've just put 3 industrial metals here, zinc, copper, aluminium, and nickel, just to sort of show you that the precious metals are selling off pretty hard, but industrial metals are still holding really, really well. However, if rates go up, then we expect growth assets to be impacted to some degree as well. Looking a little bit into the gold chart, right? I've got a volume profile here, and the blue shaded blocks that I've got here shows you where the high volume trading happens. And there's a lot of trading happen at around 4.5K. There's a big amount of trading happening between 4K and 4.2K, but then there's not much, and we're holding into that range, but we're holding onto that 4K support, really by the skin of our teeth. If we had to lose this, which in all honesty looks probably likely that we lose this if the Fed put up rates, because what we will do is gold will lead the journey as the yields start to fall, and as we start to talk about rate cuts before the growth comes back, precious metals will lead the recovery. But if the rates go up, and these higher yields is also raising the US dollar, which is not a friend of gold. And at the end of the day, the higher the yields, the higher the interest rates, people are getting paid and rewarded to hold they're getting a return on holding cash, or getting a return on holding bonds, as opposed to getting a return on holding metals. So right now there could be institutional demand, and there could be central banks still loading up on gold, but the overwhelming public, and institutional money, is better off sitting with the guaranteed return than taking on a risk of an asset that gives you no return and potentially has more downside. So right now people aren't risk enough, and even though gold is never a risk asset, it's a safety asset. Right now it's almost too risky with the price of bonds going up, and high real yields doesn't reward precious metals, unfortunately. So the key level we're watching here is this 4,000, and if we had to lose this 4,000 or 3950, then it's a far drop before we get to a support level, because history tells us that there's very little trading, and we got through this level incredibly quickly with no resistance, and that generally means that we'll get through this level pretty quickly with no support, until we get down to this April to May last year, this big consolidation that we had that was between 3,100 and 3,500, and that's where we would look for buyers to step in again, is probably 3,500. So that's what I'm looking at for gold. If this holds, great, but the macro environment is not really good for precious metals. So if we lose this, that's the level I'm looking at, 3,500. Silver is, the level's a little bit better. So silver has sold off more than gold. And silver's at a really, really good support level right now at that sort of $44, $45. If we lose that, the next big level of support is between 48 and 52. And that's where I would hope to see buyers step in. But if we lost that, then it's then it's all the way down to below $40. But silver as well is already come down to the 618 retracement level. And the 618, a key Fibonacci ratio where we tend to see buyers step in. And you can see the level of support that silver has had at the 618. Going back to gold, the 618 is below that key zone. So we actually have only dropped to the 382 retracement level on gold. So gold is holding up a lot better than silver, which sort of tends to tell me that silver might be done and silver might be ready for a bounce, but the macro conditions for gold isn't right. And if gold loses this key level, it might drop further. But potentially silver won't drop as far, and silver might come back to that $48 to $52. I hope you found that interesting. I hope you found it helpful. At the end of the day, I'm seeing a big change in the markets. I think with these big macro events that we're starting to see is really starting to shake up the market, and we're starting to see breakdown in structures. So right now, my probable suggestion would be is go into defense mode. And David Bird has a great saying that defense wins championships, right? And sometimes it's not about going on the offense, but it's really about looking at defending your portfolio and bracing a little bit for impact, because we've seen Tesla and we've seen Alphabet, Google, miss their results this week. Well, not really miss their results, but their forward guidance, the cash flow was a real significant issue for Google. And the amount of money being spent in AI, the capital spend in Tesla, was really frowned about. And straight after those results came out, immediately Google was 8% down and Tesla was 14% down. The market is demanding perfection. And if we don't deliver perfection during these earnings results, the stocks are going to get punished. And then we've got that second backdrop of, are the Fed going to raise rates? And everything, all the data that I'm looking at certainly tells us that there's a very, very high probability that we're going to have rate hikes into the end of this year. So I'll leave that with you. Have a great week. Bye.